Peter Lynch is a legend in the world of investment. Being one of the most successful investors in the world, he has a lot to teach. From 1977 through 1990, Lynch managed the Fidelity Magellan Fund, which had one of the best investment track records with an annualized return of 29%. The fund had $20 million in assets when Lynch took over as manager in 1977. With $13 billion in assets, it became the biggest mutual fund in the US. He was given a place in the Investing Hall of Fame because of his ability to manage such a huge sum and deliver admirably. Welcome back, everyone! In today's video, we will be discussing a few advices by Peter Lynch on how to invest in 2023. Let's begin! Number 1. Your stocks will need to do better overall. In your lifetime, you only need a few high-quality stocks. If you have several stocks, some of them will perform averagely, some will perform passively, and if one or two perform well, your results will be fantastic. When certain equities gain 20 to 30%, investors sell them and cling to the losers. It is comparable to trimming the flowers and watering the weeds. It would help if you allowed the powerful to make up for your errors. One intriguing company would be found if you looked at 10 of them, 2 would be found if you looked at 20, and 10 would be found if you looked at 100. The game is won by the player who moves the most rocks. If you're good in this line of work, you're right 6 times out of 10. You'll always be at least 90% accurate. This is not like pure science when you suddenly realize the solution. You must be willing to assume some risk. Number 2. Don't let fear overwhelm you. Unscrupulous investors frequently transition between the 3 emotional states of concern, complacency, and capitulation. Concern following a market decline or an apparent slowdown in the economy. This makes it harder to find affordable ways to purchase reputable businesses. Because the stock price keeps increasing, complacency builds when investors purchase at greater levels. Ironically, now is the time to exercise caution and double-check your fundamentals. Finally, the investor gives in and panic sells when the stock price plummets to levels below the purchase price. Such investors consider themselves long-term holders until the next significant decline. At this point, they immediately change their minds and become short-term holders, selling out at a loss. Successful stock market investors endure temporary losses. Despite disastrous drops, they continue to play. The secret is to discipline yourself to disregard your gut instincts rather than trust them. Number 3. You will be tricked if you believe you can play the market. The exact people who claim to be playing the market as if it were a game are the ones who are bad at choosing stocks. When you play the market, you want to receive rewards immediately without putting in any effort. You want to experience the thrill of holding one stock one week and another the next. The practice of playing the market is extremely destructive. The general public approaches stocks differently than they do other types of investments. They conduct a study before purchasing a refrigerator. They spend days researching their frequent flyer programs and weeks organizing their vacation. They investigate before making a microwave oven purchase. He says, long term, the stock market's a very good place to be. But more people have lost money waiting for corrections and anticipating corrections than in the actual corrections. Trying to predict market highs and lows is not productive. Consumer reports are obtained, and people are questioned about their preferred oven brand or the kind of automobile they would like to purchase and why. However, they will put $10,000 into a bizarre stock they heard about on the bus ride to work, and they need to know what the business conducts before dusk. Then question why they are losing money. They frequently have a history of losing consistently and acting on their hunches. Number 4. Recognize when to buy and when to sell. According to Lynch, you should buy stocks if you believe the firm is strong and that the price you are paying is reasonable for what you are receiving. Additionally, there are particular times when equities are discounted. The first is near the end of the year when businesses liquidate a lot of their stock, and you may buy them for a discount. Second, anytime there is a downturn in the stock market. Although you might be tempted to sell at these times to lessen your losses, fight the urge and buy while stocks are still affordable. Avoid selling your stock too quickly anytime you can while selling it. Lynch cites numerous instances where he disregarded the advice and sold a stock that was still increasing. Number 5. Buy as many stocks as companies you understand. Lynch thinks that you should invest in as many stocks as you feel you have the expertise in or that you have thoroughly examined and believe in. For instance, if you work in the automotive sector, you may be very knowledgeable about a certain automaker, or you may have done a significant study on a new coffee chain that recently debuted in your community and are confident in its future. As a result, you would invest in both stocks. Another strong argument in favor of investing solely in businesses you know about is this. Analysts and advisors who assert to know more about a firm than you do typically get their information from the business. Lynch advises buying 3 to 10 equities if you have a target number. Multiple stock holdings are important since they can improve your chance of snagging a tenfold increase. Additionally, if you own numerous equities, you can divide your funds across them, which we'll discuss in a subsequent section. Number 6. Doing some basic research will keep you grounded. After researching a company's earnings potential, financial situation, competitive position, plans for expansion, and other factors, invest in it. Hold onto it as long as the underlying narrative behind your investment has stayed the same. He says, stocks aren't lottery tickets. Behind every stock is a company. If the company does well, over time the stocks do well, and vice versa. You have to look at the company. That's what you research. Never use economics to forecast the future. You have squandered 10 minutes if you spend 13 minutes a year on economics. Put your companies first. Prices for second-hand cars pique your interest if you own auto stocks. You should be interested in what has occurred to metal inventory if you own aluminum companies. If hotels are your stock, your study should reveal how many people are developing hotels. Deal with reality, not future predictions. That is indeed prophecy. That is ineffective. Number 7. Create a portfolio based on your level of risk tolerance. Lynch advises taking into account the risk and gain related to each stock kind while building a portfolio you are comfortable with. Then, buy stock classes that offer you a risk-to-reward ratio you can handle. Slow-growing businesses are the outcome of low risk and poor gain. He said, in the stock market, the most important organ is the stomach. It's not the brain. Reliable businesses are the outcome of low risk and profit. Cycle firms and hidden treasure companies produce results with low risk and high payoff. Fast-growing or underdog businesses are the outcomes of high risk and tremendous reward. Number 8. Take your counsel on how to manage your portfolio. Lynch's final advice for managing your portfolio is to refrain from selling simply because forecasters advise it. Make your selling decisions based on your research and ongoing contact with the firm. You take action when you are certain that a particular external factor would harm the business. Like this, refrain from paying attention to cliches or ideas about when to buy and sell, such as, it's always darkest before the dawn, or if it's this low, it can't be possible to go any lower. Since there is simply no one guideline that applies in every situation, it is preferable to use the information of the organization you have gained via study. Ultimately, they are even more certain that stock investing is a game, but only because they have made it one. That is all for this video. We will be back soon with another informative video. Don't forget to like and share this video. Until next time.